Okay, so for the next method of non-discounting method is the accounting rate of return, or ARR. Okay, so by the way, for the non-discounting methods, we only have two methods or techniques or tools. Okay, so the first one was the payback period, okay, and the second is the accounting rate of return, or ARR. So here, uh, when we say ARR, okay, or accounting rate of return, so this measures, the return on a project in terms of income as opposed to using the project's cash flow. Okay, so if you could still remember, in our payback period, we use the project cash flow. So here, for the ARR, we will use the income. Okay, so here, to determine, okay, or to compute the accounting rate of return, so we have this formula. So this is equal to average income divided by the original investment. Okay, so here, ARR, by the way, we are talking about the rate here. Okay, in the payback period, we determine the acceptability of the investment in terms of number of years, okay, to recover the investment. For this case, we will use the percentage rate. Okay, so ARR does not consider the project's profitability, okay, like that of the payback period. And since this is also a method under non-discounting, so it also ignores the time value of money, just like your payback period. Okay, so the average income. How do we determine the average income of the project? So this is obtained by adding the income for each year of the project, and then we will divide it by the total number of years. Okay, so normally this is the usual formula for computing the averages. Okay, so annual income is approximated as annual cash flow less your depreciation expense. Okay, so please take note of that. Okay, but normally we also deduct the depreciation expense in computing for the income. Okay, if you could still remember. So, to understand better, we will take this example. So, assume that an investment requires an initial outlay of $300,000 with no salvage value. So, the life of the investment is 5 years with the following yearly cash flows. So, this is in chronological order. So, for the first year, so the investor receives $90,000. The same with that in the second year. For the third year, they received $120,000. In the third year, $90,000. And in the fifth year, $150,000. Okay, so this is the information related to the investment. Okay, so here, first, we will determine the average income. Okay, so please take note, our average income is deducted by the amount of depreciation expense. So that's why, so in the first solution, number one, we will compute for the yearly depreciation expense, and we will deduct it with the net income provided for every year. Okay, so based on the data, the yearly depreciation expense, we already know this, cost of the investment minus salvage value divided by its useful life. So for this type of investment, our yearly depreciation is $60,000. Okay, so what you're going to do is to deduct this amount for the net income received every year to get the operating income. Okay, to average that, so all you have to do is to uh, add all of this net income and then divide it by the number of years. Okay, so our average income is $48,000. So after determining or computing for the average income, so we can now compute also our accounting rate of return, or ARR, following the formula. So that is the average income divided by the original investment of 300,000. So therefore, our ARR is equal to, okay, that is 16%. Okay, so this is 16% ARR. Okay, so here, how do you know if this project is acceptable or not? Okay, so our measure or benchmark will be the cost of investment or the interest rate, for example. Okay, but normally, what we are using is the cost of capital. Okay, mean to say, what rate or percentage rate, okay, does it takes for us to um invest, okay, in terms of ratings, okay, and then we will just compare it with this accounting rate of return. So normally, the rule is that ARR should be greater than that of the cost of capital, okay, or cost of investment, to be acceptable. Okay, so that's how you determine, okay, the accounting rate of return.